and
Right, good morning everyone. Welcome back to those who attended the previous session on service performance reporting. That was a fantastic session and really good attendance. Thank you. So this second webinar session for this morning is on accounting for interests in other entities. We're going to be running through till shortly before 12. We'll definitely take some questions at the end. We'll get through to that, and then we can start to think about lunch, start to think about the weekend. I'll be starting to think about the All Blacks playing tomorrow, which will be fantastic. But we've got to get through the next hour, an exciting hour on recent exposure drafts issued by the New Zealand Accounting Standards Board through the XRB. So good morning, my name's Anthony Heffernan, Acting Director of Accounting Standards. The focus of the session today is to provide an awareness of 5 exposure drafts, recent exposure drafts issued for PBEs, public benefit entities. Only Judith can hear you. You're going to have to start again. So no one's heard me. Right, good morning, thank you. Welcome to our second session, our second webinar of this morning. And today's focus of the next hour is accounting for interests in other entities.
Okay, so if these attendees sit on hold and I can't actually it says press *1 to start the broadcast. Try again.
Good morning, welcome back. Just had a few technical issues, but we should be up and going, and everyone can hear me now. Welcome back to our second session of this morning, our second webinar. Thank you. I've just got a nice thumbs up. That's all good to go. That makes me feel better. Okay, so welcome back. Thank you for your patience. Right to start on the second session, our second webinar of this morning. The focus of the next hour or so, to get us through till 12 o'clock, is on recent exposure drafts issued by the XRB on PBE interests in other entities. These exposure drafts have been issued for Tier 1 and Tier 2 PBEs, remembering that PBEs are public benefit entities and other not-for-profits, mainly are registered charities that are defined as public benefit entities. So these exposure drafts are applicable to Tier 1 and Tier 2 entities. But I'd also feel important to note up front that it could also be applicable to Tier 3 entities. Tier 3 entities reporting under simple format reporting have got a requirement to prepare group financial statements, consolidated financial statements. So when you're a Tier 3 entity and you have got a controlling interest in another entity or a potential controlling interest, where do you go to for guidance on defining when you've got a controlling interest? You go to these exposure drafts, eventually when they're issued. So just what do we mean by interests in other entities? We talk about these 5 exposure drafts. Interest in other entities is really talking about a wide spectrum of relationships you may have with other entities. So you may have a controlling interest. That's when you've got a subsidiary or a branch or a division or another trust that you've worked through the process, and in substance you control them. And if you control another entity, you are required to consolidate. These exposure drafts also deal with when you've got significant influence. So you haven't necessarily got control over an entity, but you've got significant influence. And that's when, in accounting speak, you apply equity accounting. So these exposure drafts also account for them. They also cover other relationships you may have with entities. such as joint ventures or other joint arrangements. Those exposure drafts also capture them. So this term of interest in other entities covers a wide spectrum of relationships you may have with other entities. The main one that majority of us are interested in, and many of you on this call will be interested in is around the control. When do I control another entity and when I don't? Because that directly impacts your group financial statements. How big are your group financial statements? What am I doing with that trust I've got a relationship with? Do I control it? Do I have to consolidate it? Or can I leave it to the side and leave it out of my group financial statements that are filed with Charity Services as a PBE entity? So our primary focus of the next hour or so is to provide an awareness of these exposure drafts. Very important to highlight their exposure drafts, and I'll keep saying that. They're not finalised. We're going through this process. We're very keen to get as much feedback as possible to get these exposure drafts in the best place possible when they do eventually become standards. So your feedback is critical on that. It's absolutely very important. So if any time I use the word or get into the mistake of referring to these as standards, please correct me in your own mind. Anytime I use the word standards, I do mean exposure drafts. Nothing's finalised. So before we dive into the detail of these 5 exposure drafts, the headline news, and this is where I may lose people. I hope not too many people drop off, but the headline news is that these 5 exposure drafts are not significantly changing the world. I'm quite happy making that statement. They don't introduce significant changes in the current principles that we've got for accounting for interest in other entities. But what they do is add additional guidance, and they tidy up a few areas. And by additional guidance, there is a lot more pages in these exposure drafts, more words. So what that means in practice is that for many entities, their group financial statements, how they account for interest in other entities, most likely won't change. But for certain other relationships, they will. And the ones that will change are where you've got those borderline scenarios. It's when you've had a situation in the past, we've had those debates amongst yourselves and your governing bodies or amongst your auditors about when you control an entity and when you don't. And sometimes you may have won that argument and convince your auditors we don't have a controlling interest over that other trust or that other branch, we're not consolidating. But that might have been borderline, that might have been close, there might have been significant judgment. In those scenarios, you're going to have to open up all those debates again because you may come up with a different outcome. You may come up with situations where you don't need to consolidate anymore, or more likely you're going to have scenarios when you did not have a requirement to consolidate previously, but you now do. That could happen for those borderline scenarios. So that's why it's quite important to have an understanding of these exposure drafts and letting us know if there's any unintended consequences or anything that I mention in the next hour or so that you're uncomfortable with. So just finishing off the introduction, before I dive in, I'm very happy for people to raise questions and we'll address them at the end. I'm anticipating that we'll probably finish about 10 to, quarter to 12, and definitely enough time to take questions. Questions are good because it means maybe I've skimmed over something or haven't explained it as fully as possible. So very happy to take questions. So let's get started. Oh, one final thing, just to let you know, but on the administration side before we dive in, is handouts. So the handouts have been provided when you sign in. You'll be able to see the PDF of the handouts of the slides. So they're available to print off at your pleasure, possibly afterwards. So that the handouts are there. Good to have them because there's some useful notes in the handouts. Okay, we'll make a start. The 5 exposure drafts that have been issued in February 2016 by the New Zealand Accounting Standards Board. They've been based on PBE standards, they've been based on IPSAS standards, International Public Sector Accounting Standards. We use a lot of acronyms in accounting speak. So these IPSAS standards have been issued by the IPSAS Board, International Public Sector Accounting Standards Board. They issue them first, they finalise them, and then before we issue them in New Zealand, remembering that Tier 1 and Tier 2 PBEs in New Zealand those standards are based on IPSAS standards. Before we issue them in New Zealand as PBE standards, we issue them as exposure drafts. And that's to get comments on them, to find out, check if they're appropriate for New Zealand. Specifically, check if they're appropriate for New Zealand not-for-profits, and check if they're appropriate for our public sector entities in New Zealand. So we issue them as exposure drafts. Comment period open till 30 June. This next slide provides a bit of a history lesson, and really it's answering the question, how did we get to where we are now? Anthony, we're talking about 5 exposure drafts, and when you do go into our website and download them of significant size, what's going on here? For the majority of charities that have logged in and public sector last year, you're dealing with IPSAS, adoption of IPSAS-based standards for the first time. Charities currently working through the process now, first balance dates, March, of adopting these new standards for the first time. Public sector went for the first time last year. And now you're telling me we've got 5 EDs. What I would say, there'll be a decent period before they become effective. And I'd also say that, and I don't apologise, that in the world of Tier 1 and Tier 2 entities with over $2 million of annual expenditure, we're following international standards, and those international standards are continually responding to events across the world, and always going to be subject to continual change as things change, as things happen. And that's only right, because the world doesn't stand still. But we will be providing in the ED, looking at and happy to get comments on, the lead-in period to allowing adoption, because we are wanting a settling down period over the next 2-3 years of people just getting on top of these new standards. So the history lesson of 5 exposure drafts, how do we get here? It starts with the International Accounting Standards Board, the for-profits standards that issue IFRS standards. So in May 2011, 5 new standards were issued by the IASB, International Accounting Standards Board, IFRS standards that are applicable to our for-profits. They've been issued, they've been finalised, they're effective now, they've been used by entities, for-profit, large companies, listed companies in New Zealand over the last couple of years. So for any accountants online, you should have quite a bit of awareness already of dealing with IFRS 10, for example, consolidated financial statements. So they're issued by the IASB, and then the IPSAS board, International Public Sector Accounting Standards Board, they've got an objective of adopting IFRS standards to the extent appropriate, or keeping convergence to the extent appropriate. So they look at those international for-profit standards and say, okay, what are we going to do as an International Public Sector Accounting Standards Board with these for-profit standards? And they look at them, and starting from January 2015, looked at introducing public sector modifications to make them appropriate for the public sector. Again, IPSAS standards, they've been issued, they've been finalised. IPSAS is 34 to 38. And then in New Zealand, the New Zealand Accounting Standards Board, we look at those finalised IPSAS standards and assess them for appropriateness for New Zealand, specifically for our not-for-profits and our public sector. And what we do is we, as a board, New Zealand Accounting Standards Board, sit back and think very hard about this and think about what additional modifications, what additional guidance we should be adding to those international standards to make it appropriate for New Zealand. And we issue them as exposure drafts to get comments before they're finalised. And that's what we're talking about today. So that's the history lesson. How do we get to getting to this point, 5 exposure drafts? The purpose of the 5 exposure drafts, we've got a purpose also as the New Zealand Accounting Standards Board of maintaining convergence with IFRS to the extent appropriate. So it's not automatic. We do think hard about it. But we do want to eliminate any unnecessary differences between the IFRS standards, the for-profit standards, and the public benefit entity, the not-for-profit standards. We also want to maintain convergence with IPSAS. Rightly or wrongly, we could have the debate, but not today. The debate happened 3-4 years ago. We've decided that Tier 1 and Tier 2 PBE standards will be based on the IPSAS international public sector accounting standards. That's the decision that's already been made, and we'll be continuing to maintain convergence with them. And the other purpose of the EDs is to look at adding additional guidance for our not-for-profits and our PBEs. This slide here is really not connected to the exposure drafts. I've put this in here to provide the clear message up front that these exposure drafts do not change the requirement for charities or public sector entities to prepare group financial statements. Currently, charities are required, as a registered charity, filing with Charity Services, are required to file group financial statements when you've got a controlling interest, controlling relationship with another entity. That requirement is there now, and that requirement does not change under these exposure drafts. So I'm just putting that on the table right now. These exposure drafts do not take that requirement away. What these exposure drafts could do is change the determination, change the judgment of when you determine you've got a controlling interest or a significant influence over another entity. It could change that conclusion, that judgment, but it doesn't change the requirement for you to continue to ask the question, do I control this? I've got a relationship with another entity, it's pretty close, we can kind of tell them what to do, we're kind of getting benefits from what they're doing. Does that mean we've got a controlling interest in that other entity or not? You have to, we need to all be continuing to keep answering that question and having those discussions with our auditors. Okay, so I know a lot of charities, if this isn't the number one issue, it's the number two issue currently with adopting the new PBE standards at present. It's deciding what entities require consolidation. We're talking about branches, we're talking about chapters across the country, other charitable trusts that they've set up. Do they need to form part of the consolidated financial statements? They're all current questions faced by now and all questions that will continue to be asked. Right, so just setting the scene of what we've got now, and what we've got now, these three standards are what you'll be requiring to adopt, required to use over at least the next 3-4 year ends. And the main one that most people are focused on is IPSAS 6. Again, that's consolidated and separate financial statements. IPSAS 6 is the current standards that defines when you've got a controlling interest over another entity and when you don't. We've also got IPSAS 7, accounting for investments in associates, when you've got significant influence over another entity. When I think of significant influence, the easiest way for my mind is profit world. And significant influence in the for-profit world is when you've got an interest in, let's say, an investment in a company, and you've got a 20%, between a 20% equity interest and between 20 and 50. So to have control, you have to have more than 50. So you haven't got control. But if you've got between 20 and 50% equity interest in a company, you've got, well, it's an indicator, a presumption that you've got significant influence. Same kind of idea for PBEs in the not-for-profit space, but a little bit harder to determine when you've got significant influence, a bit more judgment, because generally you haven't got an equity interest, you've got some kind of other relationship that feels like significant influence, but not control. And finally, we've got IPSAS 8, currently interest in joint ventures. So you can have scenarios, especially in the public sector, but also some not-for-profit, some charities that do have set up joint ventures that require certain accounting requirements that are a little bit different. Status quo on that slide. So what are we doing? We've got 5 exposure drafts. If anyone's still keeping up with me on this slide, I'll talk about 5 exposure drafts, but you see on the right, we've got 4 EDs. So just wait for it. For the next slide, we'll have the 5th ED. What this slide is really demonstrating is the exposure drafts are a bit of a reorganisation of current topics. We've got the 3 standards split into 5, and a lot of the changes under exposure drafts are just a reorganisation of current requirements without actually introducing significant change. Bit of a tidy up, bit of a let's put things in an orderly fashion in the standards, in these EDs that will eventually become standards. So we'll be running through each of these one by one. You will note ED, PBE, IPSAS 36. Got a couple of arrows going to that one, IPSAS 36, PBE, ED. That is the one standard that you'll go to that will give you, will let you know how to apply, or when to apply equity accounting, when do you have significant influence, and if you are required to apply equity accounting, what are the mechanics around that. Doesn't matter if you've got a joint venture or an associate. If you determine you're required to apply equity accounting, you're going to go to 36 for that judgment, for that guidance. So 4 exposure drafts there. We'll run through it one by one. And then, as I promised, there is one more. Always more. The last one is 1 exposure draft for all interests in other entities. So it doesn't matter if you've got a controlling interest, doesn't matter if you've got significant influence, doesn't matter if you've got an interest in it's arisen because of a joint venture. All your disclosure requirements are within one ED. That will most likely become one standard. That's the plan at the moment. So all disclosure requirements within one exposure draft. Okay, so I think we're doing all right for time. Now we're going to run through them one by one, and some we'll go through pretty quickly because there's not much change, and others we can pause and have a bit more of a discussion. So first of all, IPSAS PBE 34, exposure draft. This is the exposure draft that deals with if you're preparing separate financial statements, a standalone entity, or you may want to think of like parent-only financial statements. So you're not preparing group financial statements, you're preparing entity-only standalone financial statements. Certain charities like to provide their members with entity-only financial statements. That's fine, you've got that choice. You still need to file group financial statements, but if your members like separate financial statements, you can make that choice. Other entities have specific requirements, or maybe even legislative requirements, fairly rare, but some do have a requirement to prepare separate financial statements. So when you prepare separate financial statements and you've got a controlling interest in another entity, usually you can think of it of a interest in a subsidiary interest, is how do you account for that investment? Usually it's a one line, investment in subsidiary or controlling interest in another entity. That investment, you happen to have a controlling interest, a one-liner in your balance sheet under assets. How do you measure it? And at the moment you've got 3 choices, and those 3 choices under the ED are consistent with your parent requirements. So no change. Kind of end of story. The 3 options there are cost, equity method, or in accordance with the financial instrument standard. That third bullet point or line, in accordance with PBE Exposure 29, what does that mean? What does that mean in English? That means that you account for measure the investment at really the majority of time at fair value. So you can think of the 3 options, cost, equity method, or fair value. A bit more small print around Exposure 29, but majority of the time that does mean fair value. 3 options, currently got them, consistent with the exposure draft. So no significant change there. Right. The one we'll spend more time on is ED PBE IPSAS 35, replacing IPSAS 6 from memory. So this is answering the question, it's the key question, and I've already referred to it more than a few times of, do I have a controlling interest in another entity or do I not? And the answer to that question will directly impact what your group financial statements look like. So if you don't have a controlling interest, you don't need to consolidate, you don't need to control, you don't need to include that controlling interest in your group financial statements. And what we've got on here is the 2 definitions. So we've got IPSAS 6, current definition, and we've got the new definition. And when I stand back and look at it, and people have different interpretations, but I stand back and have a look and have a bit of a pause and a think, and the IPSAS 35, yes, it's got more words, it's got a few more elements, but is it really significantly different? And in my opinion, I'd say no, only my opinion. And in many circumstances, this definition of control is not going to change when you've got a controlling interest in another entity or not. But again, it may change the borderline decisions. So some of the things you highlight is under IPSAS 35, we've got 3 requirements really. To have a controlling interest in another entity, you need to be able to demonstrate that controlling interest provides you, the controlling entity, with access to variable benefits. That controlling relationship, you need to be able to demonstrate an ability to affect the amount of benefits that you're getting. And that ability is through demonstrating you have a power over that entity. So it's really variable benefits, ability to affect the benefits, and ability to demonstrate control over another entity. 3 elements. We used to have 2 elements in summary. 2 elements we previously had was the power to govern, power to control, and the ability to obtain benefits. So one thing you may notice is that the previous definition just had the word benefit, and now we've got variable. So what that means is that it doesn't matter if you've got an interest in another entity, a controlling interest, and that other entity's making losses. Doesn't matter if they're only making losses, you still need to consolidate them. You still need to bring them into your group financial statements. So I think many of you may be able to start to see what the naughty companies were doing under the previous definition that was sitting under IFRS, is they were using that word benefit as an ability to avoid consolidating other companies that are set up on the side that were just the loss-making companies. They could put all the bad stuff into them. So this change to variable benefits did start it in the for-profit world as a direct result of the global financial crisis and the criticism of these large multinational companies managing to siphon off their companies making losses and not putting them in the group financial statements. One of the other differences that were highlighted, and it was highlighted to me by Charity Services when they had a look at it, was the word govern. And the word govern has now been replaced by involvement. So you'll see in the PBE Exposure 35 variable benefits from its involvement. And Charity Services felt that could potentially provide wider scope for capturing more entities as being controlled. That change from govern, having the ability to be influenced, the governing board. Now you only need to have an involvement. That does feel a little bit looser. So you may need to have a think about that. So that's the definition, the old and the new. I wouldn't describe it as fundamental new principles, but I would say it could change those borderline decisions and needs to be thought carefully about. Everything in these definitions under PBE Exposure 35 is there's a significant amount of additional guidance behind this and additional pages that explain it further in the exposure draft. So what's kind of consistent with what we've got next is the concept that you've only got a controlling relationship with another entity where you can demonstrate power over that entity and an ability to obtain benefits from that other entity through that power. We've got that now, and that principle is something where most of us are very used to. We've been dealing with that for many years. What the exposure draft does provide is a stronger link, a stronger focus on the ability to show the link between those two. I would argue that's there now, but it does put some more onus on that, more focus on that you do need to demonstrate. If you're going to have a controlling interest in another entity, you need to demonstrate there's a link between the power and the benefits. So that comes through a little bit stronger in the exposure drafts, that requirement. Because if that link's not there, then you may be ending up in a situation where you don't need to consolidate. Very much a judgment call, a lot of thinking. Right, now we get a little bit more technical, and if I had you in front of me as an audience, it could be easy to get an impression of how applicable this is to you. But I would say that based on our live presentations that this has not been applicable to many entities, would be fair to say. But there is this new term, investment entities, that doesn't exist under the current standards. And what it's saying under the exposure draft, it is if you meet the definition of an investment entity, and we've got the definition there, and you've got to meet all this criteria, not just one, you need to tick all 3 of them. If you meet that criteria, and you've got controlling interests in other entities, so let's say you're an investment entity, you're a superannuation fund, you're holding investments on behalf of others, maybe some kind of unit trust. You happen to hold an 80% interest in Air New Zealand. Because you've got an 80% interest in Air New Zealand, you've got a controlling interest. So in principle, you control it. You should be consolidating fully the financial statements of Air New Zealand into your investment entity financial statements. But what this in the exposure draft says, no, under these circumstances, that's not required. That doesn't quite make sense when you're an investment entity, and you've basically got an exemption, if that's the right word, from consolidating that controlling interest. All you need to do is bring in the one-liner. So for Air New Zealand, you have one-liner, investment in Air New Zealand, have that at fair value based on the share price and your 80% shares, rather than consolidating the full set. So you do need to meet all these requirements, 3 requirements. They're fairly narrow scope. I underline the word in the second bullet point where it says solely. So an investment entity has the purpose of investing funds solely for returns. So that solely is very restrictive. It can't have any other objectives. So it's getting really narrow scope to where this is applicable. And the next slide provides the guidance around when you do meet that definition of investment entity. What does that mean? Do you need to consolidate controlling interests or don't? You don't. If anyone's spent some time getting their heads around this in the for-profit world under IASB standards, IFRS standards, would highlight that there is some differences, and you may need to go back and have a look at it under the IPSAS requirements in the exposure draft. But I'll move on because I'm fairly confident not applicable to many entities. Right, so where I do want to pause a little bit longer because this will be applicable to many of you, especially in the charity space and in the public sector, but it is a common issue that comes up for our charities and not-for-profits. And these are New Zealand modifications. So we've taken the IPSAS standards and said, okay, where do we need to add additional guidance to make this work for New Zealand? And the first bullet point is where I'm going to spend more time. And this is the concept of predetermination of activities. What does this mean? Predetermination. It is within the current, it is a term used within the current standards that we're applying now, but we have looked at it as a board and provided additional guidance. So the easiest way to run through it is a high-level example. And the example that comes to mind for me is an RSA. An RSA being an incorporated society. That RSA, the incorporated society, has set up a separate trust, a separate charitable trust. That separate charitable trust may have completely separate trustees, and the society doesn't appoint the trustees at all. And so that separate charitable trust, initially set up by the society, it's got separate trustees, and it's got a purpose of providing support for returned servicemen. So this trust holds a significant amount of investments. Those returns on investments they use to support returned servicemen. So the starting point is a high level. We could look at that and say, and there's lot of judgment in here, but at a high level we could come to a conclusion and say that the society does not control this trust that it's set up, because it's got a separate board, it's got a separate set of trustees, and the society doesn't have any control over the appointment of those trustees. So they haven't got the power, they haven't got a controlling interest over that trust. We start, but then we think we need to ask some more questions here, and we pause and we start looking at the Constitution, we start looking at the rules. And when I look at the rules, and I find that the rules of the charitable trust have got very narrow scope objectives, and those narrow scope objectives have been set up by the incorporated society. And when I look to see, okay, can those independent trustees, can they change that narrow scope? Can they change the objective of the charitable trust? And I look there and it says no. If you want to make any changes to your objectives, you need the approval of the incorporated society. You're starting to get into an area where it's starting to sound like the incorporated society has predetermined the activities of that charitable trust. That charitable trust, in essence, can't really do anything other than what was originally intended by the incorporated society. So that's the idea of predetermination. And what we've got in the next slide is a criteria. And again, you need to meet all of these. And when you meet all this criteria for another entity that you've set up, usually the one we think of as a separate charitable trust, if you meet all of these, you need to consolidate. And so many people may not be completely happy about that, because the majority of time when you set up a charitable trust, it has been set up for the specific purpose of keeping those investment funds separate from another organisation. But from an accounting standards perspective, from a substance perspective, and we've added additional guidance in here, and the board spent quite a bit of time considering this. If you meet all these three criteria, you need to consolidate that separate charitable trust. So using the separate charitable trust example, if that's been established with significant restrictions on activities by the establishing entity, and this limits the ability of others to make decisions about the entity's activities. So can those separate trustees, can they make decisions? Or is it really restricted by the establishing entity, the incorporated society? And ensures the establishing entity receives the significant benefits. So for the RXA example, that incorporated society, that charitable trust is being set up specifically to support returned servicemen. So I'd be saying, yep, that's starting to sound like the significant benefits from that are being received by the members of the incorporated society. Huge amount of judgment there, and I think everyone can see the judgment here, the discussions, the debates, and that's specifically why we've added additional guidance in this ED on this matter. And we'll be very pleased for people to go look at that and see if it works, or see if it provides outcomes that you're not completely comfortable with, and provide us with feedback before this exposure draft becomes a final standard. So that's there, and yeah, I encourage people to go have a look at it. So just going back, New Zealand modifications, that's predetermination of activities. The network and partner agreements, what I'd write down next to that, and maybe we should put in the slide really, to avoid the surprises, is just write down the word franchise arrangements. Network and partner agreements, what do we mean by that? We mean franchise arrangements. So in certain circumstances, when you've got a franchise arrangement with another entity, you're going to need to make the judgment of if that ends up being a controlling interest, if you need to consolidate that franchise arrangement or not. Within the international IFRS standards, the equivalent standard for IPSAS 35, it has got specific guidance on what to do with franchise arrangements. When the IPSAS board issued their standards, they stripped it out and said for our public sector, international public sector entities, we don't really think franchise arrangements are applicable, so they stripped it out. And New Zealand, the IPSAS standard exposure draft issued in New Zealand and put it back in. We've basically made the decision that this could be applicable, franchise arrangements could be applicable to some of our public sector entities, could be applicable to some of our charities, some of our not-for-profits. So it's called a New Zealand modification, but really we're taking the guidance out of the for-profit international standards. The next bullet point, mixed groups. And again, this is another set of guidance that is within our current New Zealand public benefit entity standards, and we're taking the current guidance with it, that guidance within our current standards, taking it out, ensuring it's not lost, and putting it into these EDs. And the mixed group issue is in New Zealand is that in terms of our new accounting standards framework in New Zealand, we've got for-profits following IFRS, International Financial Reporting Standards, and our PBEs, our charities, our public sector, following International Public Sector Accounting Standards. So for-profits following IFRS, public benefit entities following IPSAS standards. And so what do you do if you're a charity and you've got a company that's designated as a for-profit? You've got to set up a company that's trying to make money. They're following IFRS. How do you bring them into your group financial statements prepared under IPSAS? And so there's specific guidance around that, what to do in that situation, consolidating an IFRS entity into a parent following IPSAS standards. That current guidance is now in there now with the New Zealand standards, won't be lost. It's been put into the exposure drafts. And after that, it's just other really terminology changes, other minor changes. So that is IPSAS 35. You will note within the exposure draft there are some transition requirements, and there's some small print. You start off at a high level that the transition requirements are retrospective, meaning you need to go back forever and a day and answer the question, do I have a controlling interest in another entity? And what retrospective really means is you need to go back to your opening equity position of your comparative year. So opening equity position of the comparative year. And if you've got a controlling interest that you didn't consolidate previously, you're going to need to account for it from that period. But what the small print does say within the exposure draft is that the bottom bullet point, restatement to the opening of the comparative period is required, but if impractical, and this is where significant judgment comes in, the word impractical, then restate to the earliest period able. So it may bring it a little bit easier, but there's some judgment calls there around when something's impractical or not. It's definitely not an automatic out. You need to be able to demonstrate it's not practical. Okay. Right, so we can move on and we can get a little bit quicker because the 35 is the big one. 36 of accounting for associates and joint ventures. And the main changes here would highlight to the status quo. What you've got now is, well, let's put on the table that there's no changes to the definition of significant influence. That has not changed. There's no changes to the mechanics of equity accounting. Love it or hate it. Equity accounting is still there, and the mechanics have not changed at all. What has changed is a little slight change in the scope of IPSAS 35. So IPSAS 35, you go into that standard to define when you've got significant influence and when you need to apply equity accounting. And what it says there is that you're only fallen within the scope of IPSAS 36, so you're only required to apply, or you're only able to apply equity accounting when you've got a quantifiable ownership interest. And that's a slight change from what we've got currently. What we've got currently is the scope of IPSAS 36 requires equity accounting when you've got a ownership interest that is based on a equity holding, a shareholding. And that's been taken away. So it's not before, if you didn't have an equity holding or an equity, that ownership interest wasn't based on an equity interest, then you didn't fall within the standard and you couldn't apply equity accounting. So the definition has been relaxed. That equity holding basis has gone out, and it's just based on a quantifiable ownership interest. Meaning, is there a way you can measure your interest? And this is when we get back to significant influences between 20% and 50% controlling interest. Is there a way you can measure it? It doesn't have to only be based on your shareholding. It could be based on other mechanisms. And the main reason they changed it was to ensure this standard brought in joint ventures. So joint ventures isn't based on an equity interest, but you can have significant influence. That was the driver for expanding this definition. So you may want to have a look at that and see if that's going to change when you've got a significant influence over another entity. Again, it's going to open up discussions, judgments that you previously had, and start again. The other key change that comes in is, okay, we decided that yes, we are in the scope of IPSAS 36. We've got a joint venture, or we've got an associate that we're going to apply equity accounting. Oh, sorry, this is for joint ventures. We've got a joint venture. We previously currently got 2 approaches for accounting for joint ventures. And now that you can see the line, joint ventures, accounting for joint ventures, you now only got one method available. You only got equity accounting. Proportionate consolidation has gone in the ED. So if you've got some passion for proportionate consolidation, if you can see the benefits of keeping it, we'll be very pleased to hear from you. At the moment, if we don't, under the ED, proportionate consolidation has gone for accounting for joint ventures. Right, let me move into IPSAS 36, joint arrangements. And so joint arrangement at a high level is any arrangement in which two or more parties have joint control over assets or joint control over operations. So you've entered into an agreement. And again, not introducing significant change here, not introducing significant new principles, bit of a rearrangement, maybe a bit of a tidy up, but in limited circumstances, you could result in different outcomes. So you'll notice under IPSAS 8, where there's three buckets. When you decide you've got a joint arrangement, you've got three buckets that you're trying to fit into. That's going to drive your accounting. Jointly controlled entities, jointly controlled operations, and jointly controlled assets. Those two buckets have now moved into, you've got two buckets under IPSAS 36. So whichever bucket you fit into will drive the way you're going to account for that joint venture arrangement, what it's going to look like in your financial statements. Right, so we're definitely getting into near the end. This is the last exposure draft, IPSAS 38, disclosures of interests in other entities. What I'd say here is that, again, we have got new requirements, not significant, but there are new requirements. And it's a consistent story with what we're generally seeing in accounting standards. And the disclosure requirements in here are all about telling your story, and specifically telling your story when you've got an area of judgment or an area of estimates, or where you're applying significant assumptions. So if you've got an interest in another entity and it's been a judgment call, you've had those debates, there's some assumptions made, there's some estimate made around when you control the entity or when you don't, you will be required to provide additional disclosure about how you made that judgment, how you came up with that conclusion. Especially, I suggest, more importantly, when you decided not to consolidate an entity. So you may even get to the situation where you say, okay, we don't control this entity, we're not consolidating. That doesn't get you an automatic out from disclosing it. You still need to disclose what the name of that entity is, and how, if it's significant, if it's material, you'll need to disclose it, and how you made the judgment call that you're not required to consolidate it. Now that's still going to be important. Then the other ones at the bottom, the two bottom bullet points, the two bottom lines, are starting to get very narrow scope and are starting to get fairly technical and won't be applicable to many entities. But if you have got a non-controlling interest in another entity, so this non-controlling interest makes sense in the for-profit world. Haven't seen many in the charity space. A non-controlling interest is where, again, when you've got an interest in another entity, and usually based on an equity interest, and let's say you hold 80% of the share, 80% you've got a controlling interest. When we talk about non-controlling interest, that's the 20%. That's the portion that you don't control. So you do control it because you've got more than 50, but you've got less than 100. So in that circumstances, that's called the non-controlling interest. So in those circumstances, if you've got controlling interests in entities of that type and it's material, you are going to, under the ED, required to provide summarised information that are going to result in, I'd suggest, additional pages to your annual reports. Because summarised information means that if you've got this interest in another entity and you're saying you've got an 80% controlling interest, you're going to have to disclose summarised information of that other entity. And summarise means that you're reporting their assets, you're reporting their liabilities, you're reporting their net assets. These will all be one-liners in your notes. You're reporting your income statement, you report their revenue, you report their expenses, you report their bottom line, their net profit. And that goes on. You'll be required to report their cash flows, you report their operating cash flows, their financing cash flows, their financing cash flows. So you start to see how this is going to add pages. But I'd say that first you've got to decide, well, the majority of you won't have interest in other entities where you've got non-controlling interests. I suggest that's probably not going to be applicable to many people. And then you need to sit back and say, well, is that material? And what does material mean within this exposure draft? So that's that one. Information about structured entities. This is the last one. So on structured entities, what does the term structured entities mean? I'd summarize that as it's another entity that you've set up, and you may have set it up in a specific way. It's not based on an equity holding, but you've set up under a different arrangement where you may have set up to specifically avoid consolidation or avoid showing you control it. So this idea of a structured entity is really, it starts in the for-profit world and specifically applicable to them when they're trying to set up these specific types of entities. They try to get rather clever and set up structured entities in a way that they don't need to consolidate. So there's been additional requirements brought in that even if you can set up an entity in a certain way and you manage to get out of consolidation, if you meet this definition of a structured entity, you still need to provide note disclosure about what this entity is and how you determine that you don't control it. So this bottom bullet point again is focused on providing the story about specifically when you haven't consolidated an entity, you don't quite get out of disclosure. If it meets the definition of a structured entity, you still need to provide note disclosure. What we have done is I do struggle a little bit to summarize a structured entity. It gets very technical, but I have provided for your reading, for your leisure over the weekend, the full definition of a structured entity. And there's lots of words there, and it is slightly different than the IFRS, the for-profit definition, and that's where its genesis came from. But the full one's there. But it's basically when you've got a controlling interest in another entity, and you've got that interest through other mechanisms other than controlling interest, voting rights, or shareholder interest. You may have set it up in a different way. Right, so I think we've done really well. I'm ready to finish. So this final one here, just to highlight again that these exposure drafts, they're on our website, and we're extremely keen for getting as many responses, much feedback as possible. And we're very comfortable. I'm happy to receive the 10-page beautiful report from one of the accounting firms, or PwC or KPMG or second-tier firm of Grant Thornton. We get their nice, beautiful reports of 10, 15 pages responding to every question. Yep, we love them. They're great. But we're also very happy to get a one-pager. We're also very happy to get a one-liner. You don't necessarily have to respond to every question. If you've got a comment you want to make, as long as we get it in writing, we can use it, and we take every single piece of feedback very seriously. I can say that with full hand on heart. So very happy to get responses, as long as they're written. It's all good. So I'll finish up there, and we can take, I know we've only got 5-2, but we can take 10 minutes for any pressing questions that have come through. Okay, so those still on the line, thank you very much. So everything I've said must have made perfect sense, which is fantastic. I'll go with that assumption and go into my weekend happy. So we've only got one question that's come through, and that's if the webinar has been recorded, and I'm delighted to say yes, this has been recorded and available for playback at your leisure, and will be available via our website. On the webinar? On the webinar app itself. Okay, so yes, answer is yes, the webinar is available, recorded. Okay, I think that's everything. For those sitting there